The Fed, which is dominating the market conversations ahead of tomorrow's key inflation number. While a potential hike in September still on the table, our next guest expects the Fed to find an excuse to pause, saying he thinks they're more concerned about boosting growth rather than reining in inflation. Joining us now is Sri-Kumar, Global Strategies President and former TCW Chief Strategist. It's good to see you, Sri. That's not what they're saying. Sarah. That's not how they're acting. That's not what they're suggesting. They still feel really worried about inflation and that they have more work to do.
Yeah, I think they are more hawkish in their speeches than they are in their action, Sarah. Look at what they did in 2020, 2021. We had a doubling of the balance sheet from an already bloated level, maintaining zero interest rates long beyond it was necessary. So that essentially doesn't show any hawkishness on their part. Subsequently, even though they increased interest rates substantially, they were waiting to pause. And even as they paused, Jerome Powell told you in Sintra a couple of weeks ago that they were going to really keep increasing and even in consecutive meetings if necessary. It is essentially inconsistent and does not show a hawkish behavior on their part. If they want to prove that they are, the Powell should not be talking about his concern about another liquidity crisis similar to 2019. He should not be talking about what the QT is doing for that and just keep his focus just on inflation, which is not what the Fed is doing.
So what do you do about this? I mean, would you suggest that bonds are a buy? The two-year yield is higher again today at 4.9%.
I think both the 2-year and the 10-year are buys, Sarah. 10-year at around 3%, 4% is clearly a buy. If you're going to hold it for 6 or 8 months, you'll probably see it go to 3%, if not lower, meaning a 1 percentage point or more drop in the yield. And as far as the 2-year is concerned, being where it is at about 390, you're talking about, 490, you're talking about a rate which is very, very attractive to investors, provides good competition to bank deposits as well as to equities. So what this means is there is an implication for the Fed. If short-term interest rates remain so high and if the deposits flee again from regional banks, they are going to have one more banking crisis. And that's what I think Powell is worried about when he did not want to increase interest rates last month, Sarah.
So do you think it's a mistake if they wrap this up, this hiking cycle?
I think if they wrap up the hiking cycle right now, it depends on what you want to do. If you want to prevent a banking crisis, maybe you're doing the right thing. But if inflation mitigation is where he is trying to do it, he is following a path with Arthur Burns showed in the 1970s simply does not work. You cannot have the stop-and-go policy with respect to inflation. If that's his target, Sarah, then they are not doing the right thing by ending the process right now.